In terms of the average everyday investor, when it comes to protecting yourself, preparing for not only bad news, but also to just corrections within the market. Todd, what are, I guess, some general words of wisdom when it comes to portfolio?
Ignore a lot of what you hear. I have to say it. Okay, so just back up a little bit. So we saw this nearly 10% decline in the market this month. And, over the course of a month, if I lose 1% here, or if I lose 1% here, it's not so horrible feeling. But we had 2 separate days this past month where the S&P 500 fell more than 3% in the trading session. And I guarantee you that we have listeners out there who saw their accounts fall by multiples of that, because some of these stocks were falling 5 or 10% on those days. And that is hard. It is hard as an investor to watch and see that and not want to do something, right, Shannon? We are hardwired to avoid danger. Doesn't matter if that danger is a ghoul coming up behind us that we can't see, the creepy music, sounding, or if it's coming in a falling account balance. And I think that we need to kind of fight back. And the way we can fight back against those emotions and those reactions is to be very proactive, to recognize that, 3% declines, it's bad, but they're not uncommon. They happen. And, most of the time, the stock market is actually trading higher. So if you had gone out 30 days later, so if you had gone out and bought the 3% dip, you would oftentimes come out ahead within 30 days. Now, if you look at the last, just since 2000, right, you've seen the S&P 500 drop at least 3%, 66 times, 66 single-day drops of 3% or more. And, undeniably, each one of those felt absolutely horrible, right, Shannon?
It was painful, to say the least. And I think, too, one thing I want to bring out is, especially if you're a healthcare investor, it's important to diversify. That helps at least lessen the pain and the blow long term. I will say, too, though, that even if the market were to go into true correction territory, and also, too, thinking about it from a recession, even, if you will, the healthcare industry is one of those sectors that generally, I don't really like the term recession proof. I don't really think anything is. But in terms of performance, if you think about it, when it comes to medications, when it comes to surgeries even, this is one of the sectors where people will tend to continue to spend money on. You need your medications. If you're sick, you need to go to the doctor. And if you're really sick, you may have to have surgery. So there are definitely some, I guess, what I would call defensive plays that you can go after. There's stocks like, Johnson & Johnson, a huge dividend aristocrat stock that's got a very diversified revenue base, as the consumers, has a quite impressive immuno-oncology branch to it as well. Another one, too, Intuitive Surgical. That is probably one of our top stocks here. But with Intuitive Surgical, they're all focused on robotic surgery and really led the way with robotic surgery. And so there are a number of different ways that I think you can start to even just diversify the risk across the healthcare space. And really, even more so, your portfolio shouldn't just be made of all healthcare stocks either.
Right. Diversify. See, I said it. I'm going to try and go an episode where I don't, but I said it again. I would also add to that list, Shannon, that, try to restrict, don't use margin. Yes. Margin cuts both ways. And, we saw plenty of people, I'm sure, last month who ended up getting forced out of stocks because of margin calls and forced selling by their brokers. Just don't do margin. Diversify. Don't use margin. Keep a little bit of dry powder, a little bit of cash on the sidelines. It doesn't have to be a lot, even if it's only 5% of the portfolio. That will allow you to take advantage of these drops. So when a name like Intuitive Surgical goes on sale, or Illumina, or some of these other great companies that we talk about on the show, when those go on sale, you're able to step in and at least deploy some of those money on those 3% down days. And just to go back to that one more time, to hammer this point home, there have been 18 one-day drops of at least 3% just since 2010. And 12 of the 16 leading up to the 2 that happened this month, 12 of the 16, the market was higher 30 days later. So don't react in the moment to those down 3% days. Have a watch list, have some top stocks ready, a little cash on the side to be able to buy them and take advantage of it as an opportunity.